Hi, everybody. Scott Riley, the Market Update Desk, September 19th, NMLS number 157524. We went through what the decision yesterday of a half point was for the Fed. We wanted to take today to go a little bit more in depth on the background of it, and also go in a little bit more depth on the SEP, which is a statement of economic projections, also known as the dot plot. Now, not surprisingly, as we said yesterday, the sole dissenting vote on a half a point cut we know came from Governor Bowman. She's been obviously the biggest hawk that's on the committee. In fact, she is now the first Fed governor to dissent on a vote in 19 years. That's actually a pretty powerful statement. Shows how out of touch she is from everything that's going on and the basic facts of the fiscal side of it. We've talked about she doesn't have a banking background except mommy and daddy's bank. She's an attorney, doesn't have the background and depth of knowledge in all bluntness. Now, going into everything, when we look at what some of the statements were, they did indicate they're going to continue QT, which is quantitative tightening. That's the runoff of the balance sheet of the Fed. Now, they did slow down the amount of runoff, which is good because that competes with the bond sales and sometimes distresses the bond sales. Within the dot plot, it showed that we're probably going to get another quarter point on November 17th, obviously a couple days before election. That's going to be much debated and talked about in the media and on the political side, and then one in the December meeting, 12/18. Also, the dot plot showed that the members were forecasting a full 1 point or 100 basis point cut in 2025. So 1 full percent this year, 1 full percent next year. That's going to bring us to the new terminal rate of between 3.375 and 3.5. So the market did like having some definitiveness on that. Inflation. They're showing they expect core inflation to be about 2.6% by the end of this year, so only slightly moderated down, and down to 2.2% in 2025. In fact, they're not expecting their target or part of their mandate of the inflation at 2% until sometime in 2026. We talked about how this is going to be a slow move down. We got to 3% relatively quick from where we were. That move from 3% to 2% was going to be definitely an elongated time period. Unemployment. Now, what's interesting is this was the biggest number that they were off from for the last two SEPs that they put off, and especially in last year when they forecasted 2024 unemployment at under 3.9%. So they're projecting the rest of this year to come in at 4.4% and also to remain 4.4% through 2025. Now, if we get to above 4.4%, and I do think we will because I think they're drastically underassessing where we are in the employment market, you may see an adjustment to what next year's rate cuts will be. Because the reason we got this half point and the reason we got the projected total 3 cuts this year is because the unemployment rate ticked up to that 4.3%. We said that was that magical number that was going to spur the Fed to speed up the process of unwinding the tightness of policy. Now, the dot plot. So 2024, we had 2 members come in and say they want no more rate cuts. We know one of them was Michelle Bowman. The other one was probably Schmidt. They're definitely the outliers on this. 7 members are looking for a projection of a quarter point more cut this year. 9 of the members are saying a half a point. We had 1 member come out and say they want 3/4 of a point more. That means one of the next 2 meetings, they want a half a point cut. Now, that the interesting thing is we're thinking that's Goolsbee. That might be the one that is forecasting or looking for a half point cut. Unemployment, what they're showing is the members on the dot plot, 9 of them are looking at unemployment from 4.2 to 4.3%. 10 of them we're looking at 4.4 to 4.5%. I think it's going to be on that upward side, like we just said before, but it kind of breaks down what all those members are looking at. Now, the Q&A session of Chairman Powell's was a little bit interesting. Indicated they don't see a recession. Spending and growth remain resilient. I'd argue growth, the real number is probably less than what we're seeing. It's spurred on by financing retail sales. And the half a point is their commitment to not getting behind the bar on easing fiscal policy. One of the reasons we didn't get a benefit in the market yesterday for mortgage rates, because the market didn't really like that. The market does see that they were behind. They really needed to start in the July meeting, not the September. So that did give a little sticking point in yesterday's 10-year bond. Also, they're seeing just continued, the GDP they're seeing is going to be consistent at about 3%. So we're going to see where all those come in at. Now, we did have initial jobless claims today. Initial jobless claims fell 12,000 to 219, lower than estimates of what the market was expecting. Continuing claims fell 14,000, which is still near one of the higher levels, actually since November of 21. As for this recent decline of the 19,000, and for the 14,000 in continuing claims specifically, it's really unclear if that's because people are getting hired, because that's opposite of the data that we're seeing, or if their benefits are just expiring and they have not found a position yet. We tend to think that it's citizens coming off of the continuing claims rolls. Existing home sales, now these are for closings on homes for August, and that fell 2.5% to an annualized pace of 3.86 million, which was definitely weaker than the market was looking for. The July reading, though, was revised slightly higher. The report measured people that are shopping for homes in June and July. Now, the big thing to understand is this is before we got this lowest leg of the rates dropping. So we do expect activity to pick up in the next report, probably significantly. Inventory increased 0.7% month over month to 1.35 million units, and inventory is up 22.7% year over year. But just to understand, we're still down 27% from pre-pandemic levels. So that means there's a 4.2 month supply on the market, which is still a little bit restrictive because 4.6 months is really considered in balance. Here locally in West Michigan, that's definitely not the case. We have come up actually a good amount of inventory, but keep in mind, we were sitting at 0.6 to 0.7 months inventory. And in the last report from the Association of Realtors that just came out earlier this week showed that we were at 1.3 months. So yeah, we went up, maybe 40% from 0.6.7% months to 1.3, but it's still near historical lows. So it's still very, very competitive. Nationally, homes remained on the market 26 days. And that's up from 24 days in July. 24% of homes were sold above list price. It's down slightly from 29%. Keep in mind, locally in West Michigan, we're still seeing a lot of bidding wars out there. Median home price came in at $422,600. First-time buyers accounted for 26% of sales. That's down from 29%. Cash buyers, 26% of sales. It's down 1% from last month. And investors ticked up from 13% to 19%. So when you see investors coming in the market, it tells you they're not looking to lose money. Don't get beat out by investors. Get out there and start shopping now. Corelogic reported blended rent rates rose 2.8% year over year in July, which is down from 2.8%. We still do continue to see market price increases, but not to the extent of what we saw previously over the last couple of years. So those are things that will eventually filter through to the PCE and CPI when we get these shelter costs maybe maybe more of what closer to what real time is. So that's a better breakdown of everything. We hope you appreciate it. Like, share, give us some comments if you could, please. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. Have a great weekend, or a great weekend still. 616 293 2189.